Let's talk about depreciation and book value concepts. Companies purchase assets other than current assets. Remember, we classify assets on the balance sheet just like we do liabilities, and we have some that are considered long-term or relatively permanent assets, and we might call them long-lived assets. On the balance sheet, we might call them property, plant, and equipment, fixed assets, or plant assets. They typically have a life longer than a year, and they might include items such as equipment, machinery, buildings, land, vehicles. They do physically exist, so they're thought of as tangible assets, something you actually put your hand on. They are owned and used by the company in the normal operations of the business, but typically are not offered for sale as a routine part of the normal operations of the business. This does not mean that they may not be sold at some point by the company, but typically not in the normal operations, everyday operations of the business. It's not what they are in the business of doing. Part of the cost of the asset would include what's called the historical cost, so what is paid for the actual asset, plus other costs such as freight costs, costs of installation, fees for closing, insurance may be incurred to get that particular asset to the company. All of those costs would be included in the total cost of the asset when you're preparing to make your journal entry. Now let's look at an example. Here we have the historical cost principle. Remember, this is one of our generally accepted accounting principles. So an example, a purchase of land by a company for $100,000. Fair value of the land is $105,000. How do we book it? How do we prepare that journal entry? Well, we're going to debit land for what was actually paid for the land, $100,000, and then we would credit cash if this asset was paid for straight out by check or cash, or if it's financed, then we're going to record a note payable for the $100,000. Here's another example. Purchase of equipment, $200,000. The fair market value is $210,000. So again, the way that we're going to prepare this journal entry is to record this asset for the amount that was paid for it. Equipment, $200,000. Cash or note payable is going to be credited for $200,000. So the costs of these fixed assets, such as equipment, buildings, vehicles, should be recorded as an expense over their useful lives. Recording the cost of the fixed assets as an expense is called depreciation. Remember that depreciation does not necessarily measure the decline in the market value of the asset. It does not mean that the company can't continue to use the asset. It doesn't mean anything at all like that. It just means that we're going to be expensing off some of the cost of this asset over its useful life. It also does not mean that cash is being set aside to maybe replace this asset, because we are not moving cash around at all. As you see from the depreciation expense and accumulated depreciation, which is going to be the entry that you make every single time you prepare a depreciation entry, cash is not moved. So accumulated depreciation is a contra asset account. This means it increases on the credit side. It does pair up with the asset. In this case, there would be one for equipment, there would be one for building, there would be one for vehicles, and it's going to pair up to its capital asset meaning we're carrying it on the balance sheet and we are depreciating it off. And notice the contra means it's carrying the opposite side balance. Notice your ledger accounts on the screen, equipment, left-hand side, I'm showing the debit here, and just assuming we're going to have other videos where I will show you how this depreciation expense is arrived at, but assuming depreciation is $15,000 in year 1, $15,000 in year 2, $15,000 in year 3, well then at the end of year 3 we see that there would be a total of $45,000. It's accumulating, so a total of $45,000 in this account. That's not cash. Though that's just your accumulated depreciation. Another reminder there, do not depreciate land. What about the $45,000 and how does this look on the balance sheet? So book value is cost of the asset minus the accumulated depreciation. So notice on a balance sheet, I just have a partial here. Down under plant assets, equipment, $200,000. I've kind of inset it for a nice form. Accumulated depreciation on the equipment was totaled up to be $45,000. So bringing that number over, notice, is $155,000. Notice it carries over on the same line. We also had land. Land is not depreciated, so adding the two together, we get total plant assets of $255,000. This would show up again on your balance sheet, and adding to your current assets is where the $425 comes from. A different way it can be displayed is this. Land is the same, equipment, and then accumulated depreciation is subtracted. And we have this other line now underneath that just says equipment net. So you could see it represented either way. When you do see an asset and the word net afterwards, that's typically going to mean that the accumulated depreciation has already been subtracted.